Welcome to Salty Investors, episode number 8, and I'm joined as usual by Tim down there. How you going this week, Tim?
Brilliant. Yourself?
Oh, not quite brilliant, but not too bad. Not too bad. But I am going to go out on a limb here and predict that I know what your salt is for this week. I'm going to say it has something to do with the RBA raising rates a modest 25 basis points. Am I onto something here or what?
Oh, you're pretty much on the button there. I was expecting 50, seeing a 7 print on the CPI number,
You and Bill Evans.
Yeah. And, I've been told the story over the last few months. Oh, we don't need to lift as much as the US because, our CPI number isn't as bad, But now we've got a 7, it's a 7 on the front of it. And we're still only doing 25. And you see overnight that the Fed's done.
Fed went 75.
Yep. And and so we're looking pretty weak at the RBA. What are they doing? So that's my salt.
Yeah. Fair enough. We'll get into that later on, obviously, because it's been two biggest sort of events of the week. Just briefly, my salt is the ever-growing cacophony calls for windfall profits taxes, not just here in this country. They're doing it in the United States. And mostly this is political. The people who are calling for it don't like mining companies. And the other half of it is they don't know anything about mining companies, how they, invest a huge amount of capital. And for years, sometimes they don't make any money at all. It's just losses and it's very cyclical. And yes, they make money in certain cycles. And of course, yes, war helps. But were they calling for windfall profits taxes when the banks were? I think some people actually were, but like in the first lockdown during COVID, you basically couldn't shop anywhere except Coles and Woolies. Did they call for windfall profits taxes on those? I don't think so. This is largely political. I did want to read out something from Larry Summers. Oh. Now, Larry Summers is not a friend of the show, but he has the potential to be a friend of the show. This is his first appearance. Now, he said, this is in relation to the United States. He said, I'm not sure I understand the argument for a windfall profits tax on energy companies. If you reduce profitability, you will discourage investment, which is the opposite of our objective. So he actually understands the fact that there's an underinvestment in traditional energy sources. And then he went on to say, some say the windfall profits tax is infra-marginal because only profits on old from past investments are taxed. This neglects the efforts of today's actions on expectations of future taxes. Disastrous Carter administration energy policies relied on a similar idea about old and new oil. So, this is someone who's old enough to remember the Carter administration. I mean, I was alive, but I think I was 2 when Carter was in 1976. So, that's a lot of calls behind the profit taxes are a little bit ignorant. The problem here in Australia, of course, is we have a gas cartel that is mainly foreign owned, that has a commitment to send gas all around the world and make a lot of money out of it, and doesn't want to reserve enough for the domestic market, even though they have entered multiple agreements to say that they would. That's the problem. And the Australian government, if they have those agreements, Turnbull was the first one, I think, to enforce it. They should carry them out, but they're not. The Labor Party has not shown much backbone here, and it's really up to AMO, the regulator, to do that. But that's the salt I've got for the week. Windfall profits taxes. Okay, so the RBA raised 25 basis points. They're now at 2.85. Now, you said earlier in your salt that, look out, our inflation's 7. They're now expecting it to hit 8, according to their latest statement. So before, what they said, peak around 8 later this year. So the latest CPI number we have was for September. We will get October's CPI number at the end of this month. So they don't have many. There's not many months left. It's going to run out of months pretty soon. So, and I think the other things I just highlighted in yellow there were that the central bank forecast CPI to be around 4 3/4 in 2023 and a little over 3 by 2024. That to me does not fit the definition of transitory, right? So it's going to be elevated for at least, if you count this year, 3 years. That's not I don't, some people's vocabulary that might be transitory, but I just still think that people are underestimating the extent to which that inflation becomes entrenched and it's just not going to fall off a cliff overnight. So I mean, the last paragraph there that I included, I mean, it's pretty standard stuff. Monitoring global economy, blah blah blah. But they do say the size and timing of future interest rate increases will continue to be determined by incoming data dependent. They're resolute in their determination. And the second sentence there, the board expects to increase interest rates further over the period. So they're clearly going into the threes, which is, I thought they'd stop here. I thought they'd stop at 2.6, 2.85. That's where I thought they'd stop. But they might not go again in December, but I'm pretty sure they'll go. Obviously, they're going to just wait for the noise of people complaining. I don't know what I've seen more and more stories about, my energy bills are going up, my mortgage payments going up. We have to cut back on everything. There's these usually emotional narratives that are put in the mainstream media. And that's just going to heat up more. There's going to be more pressure on the government to do something, even though they can't do anything. They've got to pretend like they can. I mean, they're definitely going over 3, I think. I mean, Stephen, who's that guy? Koukoulas? You know him? Koukoulas, the economist. He keeps saying he thinks they're done. And I don't know.
That's dangerous.
Yeah. But I mean, he is an economist, so I mean, he should be wrong because they usually are. So, but I mean, they're going to keep going.
So if it's closer to 5, like, surely they've got to be, getting to the 4, like 4 something, like, well.
Well, yeah. I even with all this talk, and we're going to have inflation year over year at 8 at some point before Christmas, according to the RBA, I don't even think they'll get to 4. I don't think they can. They're going to crater too much. Even the bond market has said. So last week we showed this same curve, and it was up to about 4.2. Now the bond market's now pricing that it won't even get to 4. They're at about 3.85, 3.9. Now they changed their mind, like they changed their underpants. So this is a moving feast. And the table below says that, about 30% think no change next meeting, which doesn't seem to line up with their with the statement. If you think, if you're one of those 30%, I mean over 70% still think that they're going to go the other 25. But yeah, you got anything to add to that?
There's still 4 hikes, even at 25, and like that's still a lot of months where everyone's going to be holding on. Because I hear everyone complaining now, saying, inflation's going up still, but interest rates are hitting us as well. So we're getting a double whammy on the economy, but it's not working. So for me, it's like, well, you're not doing big enough. We can't blame fiscal too much. Like, even the Labor government isn't printing so much money, so I can't blame them. So I don't know.
It is. Don't you think this time around, if the slowdown's going to happen, you're not going to show up in consumers first, because consumers have been cashed up, especially in the United States with that latest stimulus bill. I think Jamie Dimon came out and said that the excess deposits on deposit at his bank, he reckons they'll run them down by June next year. He said that in the latest earnings call. And so it's more likely, because when you look at things like PMIs, the Purchasing Managers Index, they're already rolling over. And it looks like it's more likely to be led by companies than consumers. That consumer spending, like, I feel like Australians' Christmas will be pretty solid. It won't be until, the hangover after Christmas, and people look at their energy bills in January, and, and the mortgage payments are still going up, because they will still be going up. But we've been saying this for what, 2 or 3 months now. How long we've been doing this? 8 episodes. My God, that's 8 weeks. Yeah. So just more of the same. I
Yep.
think more underestimation and just more pain than people think. Although some people say this is just a headline I grabbed about the Fed's decision. Fed approves another jumbo interest rate hike, but also signals go slower. Now, the only thing they really say, they say Powell said in a press conference at some point it will be appropriate to slow. Well, of course. I mean, we don't think they're going to 30%, do they? Do we? We're just going to keep going 75 basis. Of course, that's going to happen, but he's also said that their forecast is that it would top out around 4.6.
Wow.
So, who knows? I think they do have a meeting in December, but not one in January. I'm not sure. But let's say they go 50 next meeting, and I guess people can start to see, that maybe that's it. They seem to be more advanced than we are.
Yep.
Our inflation is still rising. Theirs is sort of, at least you could say, leveled off.
Yeah, well, I think if they do 50 next time, which is what the market expecting, so, and then they probably only have to do a 50 or a 25, in the new year, and I think that'll be enough to slow it down. But I think the market will rally then. So that, going back to my February prediction. So that's why I think it's gonna, and the market will rally as soon as it starts to see, they're gonna hold at this sort of level. But
I mean, I can see that happening as well. I still think that if you think that the market has seen its bottom already, it suggests to me that you also then think that the recession, to the extent that we have one, is going to be mild.
Yep.
And I'm not so sure about that. I don't have any real clarity on that. The only thing I think with a high degree of certainty is that earnings estimates have to keep coming down.
Well, they still haven't. You see, analysts are still.
They are coming down, and I think, nowhere near to the extent that they need
a recession level. Like, it's not like 20% corrections. I'm not seeing that yet. So
no, that's what. So it's not the easiest to see, but the white line is the 2022 EPS, and it's currently at 223. It was, as you can see, about 230, not quite. So it's the outside. There's three bands there, obviously. So it was 230. It's 223. It's not much. It's not even, what's that? It's not even 5% down. So I think I said to you earlier, I think it's got to. Well, actually, most of this year's over. I mean, this is not that important. I think that the orange line, 2023, which has come down from, call it 249 to 232. That's a bigger. It's still not even 10% though. It's not even. It's about what, 7% that it's come down. I think that's got to probably come down to 200.
Yeah.
And then what sort of multiple do you have on that? If it's a 16, then you're at 3,200 on the S&P.
Wow.
So, and what if it's worse than that? And then 2024, I mean, they were at, look at that, they were at 275 back in April. And now they're at 253. So they've come, it's still only about 7% reduction. So I think they've got further to go. But so they already have been, I guess, since around June, they've been ratcheting down, but it's just very incremental. And notice the, I think 2023 is sort of the important one here. Notice the steepness of those discounts getting steeper.
Oh, yeah.
The revisions are getting steeper. So, I think maybe that's going to continue. But I don't know. I mean, I guess it's worth considering. Do you have a view on, or what's the counter narrative? Is there another case to be made that earnings are going to be more resilient, and what would it be?
Well, not earnings.
The US dollar reversing.
Oh, wow, that'd be a signal, wouldn't it? But I don't know. I don't think earnings. I think they've got to come down. There's no other way to put it, really. But if the Fed pivots, and something crashes, and then the Fed blinks. It happened in 2018. That's what everyone remembers. Everyone remembers 2018.
Taper tantrum.
Yep, and that's still in the market, and that's why you're seeing the EPS, and everyone thinks, oh, it's all going to go back to happy days. High company profits, low cost of capital, low interest rates, and this is what you get. No one believes the Fed. Everyone believes they're going to pivot. So
yeah, well, it's a discussion between, is he Arthur Burns or is he Paul Volcker? I'd say he's probably neither. I just don't think, I've been around long enough to just, analogs don't work that well. Like, oh, it's the 70s, and then you make the mistake of thinking that it's supposed to play out like the 70s, and maybe it plays out in a not completely different, but it's got a different tone to it. Another interesting, just sort of sticking with the idea that this won't be consumer-led slowdown because the consumer's still got some fuel in the tank. It was sort of pointed out to me, I forget who I was watching, but real estate in the United States is, the residential real estate is really solid in terms of, most people have fixed mortgages. Of course, prices have to come down to reflect interest rates, but most people, you're not going to see some mass liquidation of residential property. But you've got all this commercial property sitting in huge cities where people haven't come back to the office, and there's a certain percentage that won't come back to the office because they don't need to anymore. There's remote work, and that some of these property REITs gonna make it, they won't be able to sustain the kind of yields that they've traditionally had because the occupancy is just not there, and they can't charge what they used to charge. So that's commercial real estate.
Will it be isolated, but will it stay isolated to commercial, or will it have a flow-on effect? I don't know.
Yeah, but I just, it's a weird one, isn't it? Because you look at the American market compared to ours, and I think the number of people with adjustable rate mortgages in the United States is less than 5%. So it's a single-digit number, I think. And you think, well, that's great, but if you want to sell, or you have to sell, you're going to have to take a really big haircut just because of interest rates, just because people can't borrow enough to buy that home now. So
and if you just got a mortgage in the last couple of years and the value's gone down, like
and you're a forced seller.
You're a forced seller, and like,
I suppose it hinges on unemployment, doesn't it? I mean, as long as you got your job, and you're forced to sell, or you can live with it. But if you lose your job and now you can't afford the mortgage, now you have to sell. Anyway, earnings still got to come down. Don't believe these earnings at all. There'll be more revisions to come. This is something that you threw up. This is the power of loyalty. What's all this about, Tim?
Well, I'm on this quality trip again, trying to get away from my value investing days and trying to think, well, like, can I actually purchase quality here? And, I'm starting to look at some of these businesses, Costco and Amazon are the classics. You can see them that they just dominate the market with their subscription type models. And I'm starting to think about it in other areas as well. Like, I'm looking at Zoom and thinking, I like the company, but if you already own a Microsoft Office subscription that gives you a Microsoft Teams, are you really going to go and purchase Zoom?
Yeah.
And it works at Amazon. Amazon now is giving away their music for free to all Prime members. So would you buy Spotify? These subscription type, loyalty type programs are just eating the lunch of all these other little companies. Even if you've got a better product, like Zoom is clearly better than Microsoft Teams.
Have you used Teams?
Yeah. And I just couldn't understand it. It was just way harder to use. And I know it, but it works better within the Microsoft ecosystem.
Right. So, if you want to share Excel spreadsheets and things, I suppose, is that what it's built for? So
you've got everybody already linked in there, and already in that ecosystem, and all your documents already shared inside that platform. and you're already paying for it. It's like friendly societies. I don't know if you remember them back Flintstones days. Yeah. Like, and they sort of looked after your health and all that sort of stuff. And then the government comes along and goes, oh, we're going to give everyone the age pension. And government goes, oh, why should I pay for friendly societies? You know, it's the same sort of thing. You know, why pay twice for something that you're, even if it's worse, a worse product, you're not going to pay twice. So I'm starting to see that. And, you know, there's a couple here that are discounted, like Starbucks and Ultra Beauty. That's on a discount at the moment. And, but I'm still not sure on Marriott, you know, like, you know, for the business travel type thing, I think, you know, I don't think that's going to come back as strong as what people believe. What do you think?
Well, I mean, all the data I've seen on, I mean, travel in the US, I don't know about here, but it's going gangbusters, absolutely smashing it. And some of it's because it's not all volume. It's, you know, they've raised prices, and people. This is the problem I have. People are still willing to pay them. What happens when they run through those excess deposits, as Jamie Dimon has said? You know, it's like I think I did hear, might have been the Animal Spirits podcast that said there was just an anecdote about one of their friends who tried to book a last minute trip to Disney. No, completely booked out everywhere. Can't get a hotel at any of the Disney locations right now in the States at all. And then they're charging record prices that people are still filling them up. So people are still feeling pretty good. But you know, the funny thing about that is they're spending shitloads of money. But if you look at any of the sentiment surveys, you know, they've all cratered, haven't they? So yeah, I feel terrible, but I'm going to spend a load of money anyway. I don't know.
Retail therapy, I think they call it. That's what they're saying at the moment. But it's like, oh, that's only short-term thinking. It's going to make this, like you said just before, when they get the credit card bill in January, February, like, boy, that's going to be a bit of a wake-up call. The interest rates are going up higher. Like, wow, it's going to be very interesting.
It's interesting as a, you know, former regular YouTuber who used to make money that way for a short time. December is a great month, and then in January your ad revenue is about 20% of what it was in December, and probably a third of what it is throughout the rest of the year, because nobody advertises in January because everybody knows everybody's up to their eyeballs in debt. And then like I said, in this country, you're going to have, not only you're going to have that, but you're going to have the energy bill. Oh shit, petrol prices are still high. Mortgage payments are still going up. Lots of fun. Lots of fun in store. So have you, out of that, did you just pick these, or do you like any of these particularly? You said Costco.
Like Nike I like as well, but the problem is like, is it another Under Armour? And like another 20 other brands, you know, you can keep going back in history over the last 20 years. Is this going to hold up? But the problem with Nike, it just keeps seem to hold up over the decade.
It has. Yeah.
I can't, like, it's just got this staying power that, you know, I've got to relook at it again, that I can't understand. But it seems to be one of those brands that just can fight through generational, you know, just keep going on. Obviously Amazon's on a discount at the moment, and a whole heap of quality investors are buying.
Did I see they had negative operating margin for their last quarter?
Free cash flow, they're still, like, they're burning it like nothing else. Like, but they're it's only been 2 years they're in the new capital allocation phase. And if you're a long-term Amazon holder, you should understand how this cycle works with them. You shouldn't be fooled by them having no free cash flow. But
the last 20 years may not be the same as the next 20 years. That's the thing.
Yeah. So, but you know, they're still eating people's lunch. As I said before, they're still eating Spotify. So I don't know.
They keep sending me every month, because I'm an Amazon Prime member. They keep saying, "Come back and use Amazon Music for free," and all this other stuff. You're always throwing free shit at you.
I know, but like the thing about this Prime membership is they can just increase it by, you know, $10 a year, and you're not going to not pay it. And then all of a sudden, you know, the free cash flow just goes insane on, you know. So it's just one of these things, these little levers they can just pull, stop investing for a few years, and everything just looks brilliant again. and you're wondering why you're not invested in it. So yeah, it's one of those companies that's very hard to value and understand. But yeah, I think it's something to look forward to. But yeah, I don't like Target, obviously, and Marriott and a few of these other brands down the bottom. I don't think they're going to staying power, but yeah, Costco, that
Costco,
that shared economies thing. So they only got a 12% margin on their product. So
yeah,
they don't make any money. They just, pay your membership fee, and that's where they make all their money. But as you can see from their shopping basket here, I don't know, it doesn't show it on this one, but if you've got a Costco membership, you hardly purchase elsewhere because you want to make the most of your membership, and that just eats everyone else's lunch. So yeah, especially the economy goes bad, it's very hard to see, them doing poorly.
Yeah. So, yeah. Well, speaking of people that have pricing power, here's one, Coca-Cola. I know all about its pricing power myself. So you've got sort of decades here of metrics, and well, I guess it's historically not looking cheap. Does anything explain why it was sort of half? So I assume that's an average price-free cash flow for that period. Is that right?
Yeah. So just averaged it over those 10-year periods. But the question is like, I'm trying to be quality mindseted here. Like, would I pay up for some of these multiple earnings over these decades? And I'm thinking, some of these, like 1988 in Microsoft here, obviously 47, a 47 number there, that's hard for me to pay. But as you can see, from 1993 to 2002, 32 isn't crazy, especially when you've got a return on invested capital of 35%. And you can see today, it's still got these high returns on invested capital. And it just seems to keep pumping them out. Obviously, it looks very monopolistic. Like these numbers here, you don't see them because you've got this thing called reversion to the mean. And this is what we're all told, basic, economics is reversion to the mean. But as you can see here, these guys have just kept on finding better stuff to invest in. And obviously it keeps paying off. And I thought, can I do it with other companies? Like the classic one here is Coke. As you can see from around the 2000s, it still had a return on invested capital. I can imagine in the 80s, it would have been crazy numbers, and the 90s where Buffett was buying. As you can see here as well, it's not as good nowadays. As you can see, only 14% return on invested capital. But
I guess that's what is that? Does that reflect? I mean, so I know that sales of soft drinks, carbonated drinks, soft drinks have lost about a percentage point in volume terms for the last 5 to 6 years. But in saying that, Coke sells water, Coke sells energy drink. They've got their own, all of that stuff as well. So I'm sure they're making it up elsewhere. But what explains the return on invested capital? You can't tell me people are healthier. That's certainly not the case. You just go outside and look around.
This number is actually inflated. But this 14% currently is inflated because the payout ratio of the dividend isn't taken into account. So actually, because they don't reinvest that much money, because they pay out so much money, it's making the number look good. And then you've still got the third world as well, which is still, heaps of expansion there. Like you think Indonesia and all these other places, India, and they're still increasing their unit sales. So they've still got places to expand. It's just every time they go buy something, it's not as good as Coke. Like it's not like they're going to come up with a new Coke type product and it's going to be, they're going to be selling billions of units per year, so
well, I guess the question is, would you pay 23 times cash flow for Coke right now?
No,
you wouldn't,
because it's just got no growth. So if you understand how, I've been having this argument with this dividend investor, like online. This lady's got $1 million portfolio. I'm like, wow, I've got to save you here a little bit. Like, just don't understand how dividends work. So I thought, I'll invest a little bit of time and try to explain how prices work. Prices are reflected on how much money, a future company is going to bring in. And the high payout ratios and high dividends, meaning, they can't reinvest, and you're going to get a low growth multiple on that. And if you understand how, I just think people just can't understand it. Like there's Terry Smith's got this great article in the 80s about that capital retained gets a book value of about 3.5 times.
Right.
And when you take it as a dividend, you get 1 times value. So that means you're already down a whole heap as soon as they take it as a dividend. And also they can't reinvest and find new things. So it's just
that probably, sorry, but in Australia, because of franking credits, that sort of mindset about getting dividends is even more infectious, because it is more than 1 times in the hands of Australian investors, because you've got the gross up of the franking credits, right? So you got another 30%.
Yeah, 30%.
Yeah, I know it's not much, but I agree with you. Trying to explain to someone, look, you want to have a company that has high returns on capital, but can keep taking its returns and plowing them back into the business and getting those high returns. You're better off with that than a company that, it's a after-tax yield of 6%, but it's got no growth. And eventually, a couple of things are going to happen, aren't they? If you've got no growth, they're going to try and buy something for growth that may or may not work out. Usually won't. And or the dividend's probably going to come under pressure sooner or later, especially depending on how much debt they got on their balance sheet.
It's just trying to explain. But I'm trying to see, can I buy up quality here? Trying to change my mindset, and stop being so cheap. And like,
yeah, but I mean, I don't think. See, I think there's a false dichotomy sometimes between value and growth. There's definitely a fault. I mean, you want both. Yes. You want something that's growing at above market rates. It doesn't have to be growing 20% a year, but if it's growing at 12 and has high rates of return on capital and it has a moat quality, I'm just a bit nervous about distinct categories like there's value, there's quality, there's growth. You want all of those things, actually, don't you?
Yes,
really? So you're not. I don't think you really want to say that you're skewing value.
No.
You're just saying that you want a company that's trading on 25 times is not a reason not to buy it, because it might actually be justified.
And I'm trying to do the study now where I'm trying to go back in time and say, hey, paying a high multiple, did that work out every time? If you understood the mode. And so I've got now this 30 years worth of data. This new website called 10K Reader. It's got 10 to 20 years worth of data, 30 years in some cases of data that you can go back and, do this analysis and see, are you honest with yourself? If you went back in time, would you actually, purchase it?
I guess the one thing about your last 30 years that you had a sort of pretty much uninterrupted fall in interest rates. That was a nice runway. How's it going to work in an opposite environment or a choppy environment as well? Yeah, I'm always, back tests are only as good as that. I mean, I think it's good that you're doing back tests. You should test your theory out, but not necessarily. I sound like a fucking disclaimer now, don't I? Not indicative of future returns.
That's all I'm working on. So hopefully I can come up with something. So
interesting stuff. That's the lot for this week, isn't it? We might leave it there, hey?
Yep, sounds good.
Everybody, thanks for listening, and we will see you next time.